Hello and welcome to another in the Alpha Educational series of videos. Today with Elliot Omanson and
Nathaniel Vossman.
We're going to be talking about one of my favorite things, and that is how a trust can help you defer capital gains taxes when structured correctly.
Yes.
Right? And what kind of, we should probably start off, we talk about highly appreciated assets. What all kind of highly appreciated assets? I guess I'm asking the question here. Normally you do, but
Yeah, it could be anything like a real estate property business.
Yeah. So we've done this for a client who is selling their home in California and moving out east, and that home had significant capital gains that exceeded the $500,000 for married filing jointly exclusion. We've done this for business owners selling businesses. This can even be used for crypto.
Oh, really?
Yes.
Well, yeah. Some people are sitting on, pretty big capital gains there.
Yes.
And those would be a big tax hit.
Absolutely.
Even at those long-term capital gains rates, something appreciates enough.
Yeah.
You're still potentially giving, 20% away.
Yeah. Now, there's a reason it can be used for crypto and it cannot be used for stock portfolios.
And why is that?
Because a stock portfolio and we would probably need to bring one of our trustees that structures these deals, one of the attorneys on to really get into the nuances of this. But because the stock currency is on a publicly traded exchange, there's you can't do this. But because crypto is usually held off exchange inside cold storage, you can do it. So,
interesting.
Yeah.
Interesting.
And I should probably get more clarification as to why. But yeah, so where do you want to start?
I guess we'll kind of start at the top. I think this is a pretty easy one, but what happens when you sell something that's really highly appreciated without any proper planning? Because normally someone might just sell their business or sell their house or sell some cryptocurrency, and taxes are just part of the game. They just accept it.
They do. And because I think one of the greatest lies ever told is that, and I don't know exactly the quote, but it's something about how death and taxes are unavoidable.
Yeah.
And I would tell you only one of those is unavoidable, and that's death.
Yeah.
So
we can do a whole lot to avoid taxes. Not a whole lot to avoid death.
Correct.
Though.
Correct.
At least not now.
And something you're going to point, I'll wait to get into that. But basically, yeah, you're going to sell something. You have a highly appreciated gain on it. It's going to be counted as capital gains. And that's going to stack on top of the rest of your income for the year, which will, especially if you're selling a business, you're going to max out the top tax brackets.
Oh, yeah.
Plus,
Easy.
you're going to trigger the 3.8% net investment income tax, right?
Yeah.
And so in most states, right, especially if you're in one of, New York, Oregon, I think, we're Seattle, Washington, California, you stack that, you're going to max out the Fed's cap gains rate at 20%. You're going to trigger that 3.8. Then you're going to trigger your state taxes on top of it.
It hurts.
Well, yeah, you can lose like up to 40% of your life's work. You've been taxed every step of the way, every time you've turned around. And then you're going to get hit with even more when this happens.
Yeah. In the case with a business owner selling their business, a lot of times, a lot of people that one business is the single biggest transaction of their life.
Oh, absolutely.
And it's not even close.
Well,
not even close.
Yeah, and I would even tell you that even if you don't own a business, let's just say it's your home and you've lived in it for a long time, right? And now you're downsizing in retirement and you're W-2, that's probably the single largest transaction in your life. Now,
for a lot of people, yeah.
For most people, you've gone from home to home to home, and so you might not be sitting on this one giant capital gains hit. But like I said, for these clients of ours that lived in California, they lived in that home for a very long time. Real estate prices in California skyrocketed. And that was their single largest tax hit of their life, right?
Definitely.
Yeah.
So, how can you use a trust to kind of mitigate some of these capital gains taxes, or at least lessen the impact?
All right. So there's two concepts that we're dealing with here, and they're important to understand. One of the first ones is called constructive receipt. So you don't owe taxes on money under the current rules if you've not taken constructive receipt of that money. Okay, now there's a huge push on the part of Democrats to change this. All right. And of course, they always lie to you and promise it'll just be the ultra wealthy, right? But just like the alternative minimum tax that was put into place to impact 155 people, today it's impacting millions of people.
Yeah, a lot of our own clients. Yep.
Yes. Or when they told you that Social Security would never be funded with more than a 1% tax, they lied to you there. When they told you that Social Security wouldn't be taxed, they lied to you there. So
yeah, things change.
One thing you can always bet on is they're lying to you.
Yeah.
Okay.
Yeah.
But currently, if you don't take constructive receipt, and this is a nuanced thing. Constructive receipt means you have control of the funds. So you cannot have control of the funds. But control is not in the terms in which you think of it. It's in the terms defined by the government. And this is very important to recognize the difference. All right? So constructive receipt is one of the things that we're talking about. My mind just blinked on the second one. Dang it.
Just with the process of selling your assets, constructive receipt of
I'm sure it'll come back to me as we go through here. Geez, you know what I think I need?
I think you need a Red Bull.
More caffeine.
We're sponsored. I wish.
Maybe one day. So within the realm of avoiding constructive receipt, right? What are we trying to accomplish with this trust, right? What we want to do is enable you not to take constructive receipt, to meet the definitions of the IRS as not having control of the money, but still essentially get to use the money for your purposes, right? And so one of the things that I like to start off with is explaining a concept that this is not, but if you understand these mechanisms, you'll understand what we're talking about, okay? So the number one method or way in which businesses are sold in America, and if you just think about this, it'll make sense, right, is from a business owner to an employee, or from a business owner to an employee who's a child, their child.
Yeah.
Okay. This is the bulk of all business sales.
Yeah.
Okay. And it just makes sense because usually as a business owner, small business owner, you've got one of your kids working in the business, or you have a key employee who's most capable of stepping in and running it. They've been there for a while. They've learned the business. They want to buy it from you. Now, generally speaking, your employee and your child don't have the money to buy it from you.
Yeah, that's fair. Yeah.
They just don't.
Yeah.
This is just normal. And so how do you sell a business? And I'm using business here, but this concept's going to apply to all highly appreciated assets. How do I sell something to someone who has no money? I do it under the installment sale rules. Okay. Now there are limits. Okay. It's $5 million. You can do an installment sale up to $5 million for a single person, and up to $10 million for a married couple. So generally speaking, I'm gonna do seller carried financing. I'm gonna structure a note to my employee or child.
Yeah.
Okay. Now a note has to have interest, or it's not considered a loan.
Yeah.
All right. So I'm gonna sell my business to the employee or to my child on a term with a note, and they're gonna pay me for this business over time. So just using simple numbers, I sell my business for $1 million on a 10-year note. I'm going to simple interest here, just for easy math. $100,000 is going to be paid in interest over that 10-year period of time. And so I get $100,000 a year of principal, and I get $10,000 of interest. Now, at the end of year one, I got my $100,000 and I got my $10,000. So I got $110,000. What's taxed, and how? Well, the $10,000 in interest is taxed as regular income.
Yep.
The $100,000, if I've depreciated my business down to zero, again, just to stick with an easy, understandable example. So the whole $100,000 is going to be capital gains on the sale, right?
Yeah.
And that's going to get taxed at capital gains rates. My $10,000 in interest is going to be taxed fully as income. Now, what wasn't taxed? I sold my business for $1 million. Do I owe taxes on $1 million?
I guess not until you receive that money.
Because I didn't take constructive receipt of it, I don't owe taxes on it.
Yeah.
Okay? Now, there's risks with this, right? You got to hope that the person that you've done this sale to is good for the money.
Yep. That's
right?
pretty important.
Sure, you can have clauses in there that if they fail to make the payments, you take back the business. But rarely do you want to take back a business that's been run into the ground and have to try and rebuild it.
Yep.
Right? So we're going to take that concept right there, and now we're going to apply it to a sale where the buyer actually has the funds to pay you. Okay? But we still want to use these methodologies to avoid constructive receipt to defer the taxes. So what do? I insert a third entity. I insert a trust. And I don't know if I'm going in order here.
No, that's good.
You
Let's
can
keep.
feel
No.
free
This is good.
Okay. So I create a third entity. I want it to be a trust. You could technically create a business, right? The problem with businesses is they have owners. Ownership gives you control. That's why it doesn't really work.
Yeah.
So you're going to create a trust. It's an irrevocable trust. Irrevocable trusts, and we're going to get more into the exact type of trust later on, which is an intentionally defective grantor trust. But it's irrevocable. Because it's irrevocable, it has its own EIN. It's considered to be its own entity. Okay? So now this trust is going to, which means it has a trustee. This trustee cannot be a known party to you or related party, because that would mean you have control. Okay? It can't even have a known party or related party managing the assets in it, because again, the IRS can determine you have the ability to put control over it. Okay? So you create this trust. Now the trust has no money. So think of it like your kid or your employee. How do you sell something to something that has no money? The same way we did
normally financing.
A note.
Yeah.
Seller carried financing. So the trust is going to issue you a note, right? And let's just stick with that 10-year example. So you receive a note. And now if you think of this too, right, to really make it simple, you've exchanged one asset, your highly appreciated asset, a business, crypto, your home, for another asset, a note. These are all assets.
Yep.
Right? So you receive a note, the trust receives the asset. Now, generally speaking, you wait to do this. You do it before you get an LOI. And the reason why is because there's language you're going to want to put into the LOI that reserves the right for you to sell the asset through any number of mechanisms, right? So that way the buyer's not caught off guard, right? So you receive this note, the trust receives the asset. Then the trust sells the asset to the buyer. And in this example, now we've moved to an example where the buyer has the funds to pay you. So let's just stick with that $1 million. The buyer buys the asset from the trust. So the trust purchased it from you for $1 million. It sold it for $1 million. Is that a taxable event?
The trust sold it.
The trust bought it from you for $1 million.
Yeah.
And the trust sells it for $1 million.
Yeah, there's no capital
There's
gains.
no
there.
gain.
Yeah, same price.
There's no taxable event.
Yeah.
So now the money is in the trust. The buyer got the asset. The beautiful thing with this is now you're done. you don't have to worry about them making good on the note. You're worried about a trust making good on the note. And the trust has the underlying assets to support the note. Not much concern there.
Yeah.
Okay.
So what would be the underlying assets in this case?
Well, the beautiful thing about that is, as a note holder, you can work with the financial advisor who's managing the assets to determine what those are. Generally speaking, it's going to be some kind of investment portfolio, stocks, bonds, ETFs, etc. Right? And you have this note, and the note could be for 8% per year, right? But you only want 4% paid out, right? And that gives you the ability to grow your bucket of money while still receiving income from it, all right? And then it's the investment advisor who's been hired by the trustee to ensure that the portfolio is performing in accordance with the terms of the note, all right? Now, there's some flexibility here, right? Because there's no requirement that it's an investment portfolio in the market. So you could have, with the trustee, you could say, as the note holder, I'm more comfortable having the underlying assets of the note be a real estate portfolio. And you can buy an apartment complex. You can buy individual homes, right? You could actually say, I want to go buy another business. And you can have the trust provide the capital to acquire that business. So the thing you have to think about is the trust is, there's two ways to think about the trust. One, quite simply, that I think it really helps people, is think of the trust like any other wrapper that goes around investments. When I say wrapper, your 401k is not an investment. Your IRA is not an investment. A Roth's not an investment.
Just a vehicle.
Well, it's just a wrapper.
Yeah,
it's a tax wrapper around investments. Yeah. Think of the trust as a wrapper around the investments, right? So you're very used to having a 401k or an IRA. We'll just consider this to be something similar. Yeah. Okay? It's the wrapper around the investments, the underlying investments. As a note holder, you have some degree of workability there with the investment advisor, the trustee, to determine what those are in order to support your note, right? Now, as a note holder too, you can call the note and take the underlying assets out. That's going to create a taxable event for you, right? Because then you've taken a constructive receipt.
So how does the taxation work? Let's say you have underlying assets. In this case, we'll just say stocks, and you sell a business for $1 million. Then the trust's holding $1 million invested in stocks. So what happens when those stocks, if they do quite well, they inflate in value, and then you're pulling money out? How does the taxation work as far as, you're paying capital gains on the original sale versus the appreciation of the underlying asset?
So this is where I think the beauty of it comes in, right? Because on one hand, you could view it as I'm giving up control. But in reality, I believe you're gaining control because you have control over how the money is coming to you. Okay? So I can never take principal. And so if you think about it, on $1 million transaction, if I burn 30% of that out of the gate to the government, I get $700,000 in my bank account or brokerage account that I get to invest and kick off income to me. But if I use this trust structure, I have the whole $1 million inside the trust, which means I have 30% more assets, producing 30% more gains, producing 30% more income.
That compounds pretty well too.
Absolutely.
Big time.
Okay. And I get to, because I'm the one selling those assets to the trust, I get to determine the structure of the note. So I could have my note structured to only provide me interest. I can have an interest-only note, so no principal is being distributed. So my principal remains intact. Those taxes I owe remain deferred. And I'm just taking interest income. And again, interest income is taxed fully as income. But I have 30% more underlying assets producing 30% more income. Okay? I could, if I wanted to, structure it to where a small portion of the principal is coming out in addition to interest, which, as you could probably figure out, allows me to manage what my total tax liability is and allows me to manage the tax brackets, especially the capital gains tax brackets of 0, 15, and 20%. I could live in a state like California, like our clients who sold their home. And if I took constructive receipt of my money at sale, I'm now burdened by the California state tax. But if I route it into the trust and then do like a lot of smart people are currently doing, and that's GTFO, the state of California, well, now my income is taxed based on my new state of residence. So I could sell the appreciated asset in the state of California.
Take the money while you're living in Florida or something.
And I can move to Florida and trigger my income and now have no state income tax.
That's a good deal right there.
Yeah, baby.
Yeah, that's big time.
Yeah. Yeah. Let California deal with it.
Yeah, it's their own fault for
they're just going to funnel it to some quasi-government agency claiming to help increase homelessness anyways. Right?
Yeah, yeah.
So that's pretty cool.
Definitely. I mean, yeah. And so you say you can take interest only. So is there ever any requirement to take the principal out?
Well, there's a couple beautiful things here. One, in 1986, so previous to 1986, a lot of U.S. law is just a carryover from Great Britain, what's called common law or whatever. And one of the things that we did in order to prevent us from becoming like Great Britain, where you had two classes of people, right, the nobles and the serfs, we put a limit within our contract law, which is what trust law is based off of, that limited a contract to a maximum life of 99 years. And so if you, a trust law is built on contract law. It's the same thing. So you could never have a trust that exists longer than 99 years, right? So at 99 years, the trust would be dissolved, assets would be distributed, all deferred taxes would be paid, right? And the government's always going to outlive you, generally speaking, until
you would
the fall
think so.
of Rome.
Yeah.
Right?
Fair.
But for the most part, it's outliving you.
Yeah.
Well, in 1986, South Dakota became the first state to change and so the other thing, contract law and trust law and insurance law is all governed at a domicile level. States are domiciles. Indian nations are domiciles. And so trust law, contract law, insurance law is all governed at the domicile level. So South Dakota had the ability to change that rule and allow a trust to exist in perpetuity or forever.
Wow.
So now if I'm deferring taxes inside of a vehicle that there is no end of, there could be a case made that you're no longer deferring, that you're just literally never paying.
Yeah.
Okay. Now, there needs to be, usually the IRS wants to see that there is an exit at which point they receive their money. So you have a 10-year note. Usually most of our clients structure the notes on a 10-year time frame. Plus you want some flexibility in life because things change. So I have a note. It's interest only for 10 years. There's a balloon payment due at the end of 10 years. The balloon payment would be what would trigger the payment of those gains that I deferred. Now, let's just say that was all you did. All right. And let's say I structured my note to where the 30% of capital gains I never touched. But I wanted it to grow at 7% so that at the end of 10 years, what's happened to those capital gains?
Doubled.
They doubled.
Yeah.
I get my balloon payment. I struck a check to the government for their amount of money that's been deferred. I have an equal amount of money,
Yeah.
right? I'm going to have to pay some taxes on it or whatever, but I'm
It largely covers it.
significantly ahead.
Yeah.
But why would I do that? Why
would you?
wouldn't I just rewrite my note for another 10 years? And why wouldn't I do that 10 years later and another 10 years later and another 10 years later?
So you can just keep rewriting the
I
note?
just keep rewriting the note every 10 years, continually kicking the can down the road.
Yeah.
Unless there was some event in my life
That you needed it.
that I needed it.
Yeah. So what happens if you structure a notice one way and then you need the money now? Like year 2, year 3.
Well, so if you do it every year, right? Well, then clearly you have control and you have constructive receipt.
Yeah.
And the IRS is going to determine that that's all bullshit.
Yeah.
But if you have a legitimate life event that occurs somewhere within that 10 years, causing you to restructure the note, that's not anything that is wrong. That's legitimate, and you're fine. Okay? Now, there's another layer to this, and that's what I love about.
There's a lot of layers.
There's a lot of layers to this. And that's what I love about taxes, right? What if I had a very savvy investment advisor and trustee, and they were able to bring alternative investments to the table that could create large amount of deductions? Also, while understanding that due to the Tax Cut and Jobs Act of 2017, as a married couple, I'm limited to business losses of $512,000 in 2026. And I think that is tied to inflation. It increases every year.
Yeah.
So now I could structure my note to, over the 10-year period of time, have chunks of principal taken out along with the interest I'm earning, but I'm going to create an offsetting investment that minimizes or wipes out completely those capital gains. So again, this is what I was saying earlier, is a lot of people would look at this as giving up control. In my mind, this is you acquiring control.
Yeah, so you get pretty good control of how much tax you're paying.
Absolutely.
Which is the ultimate control.
Absolutely. So if the trust structure, for some reason, if you can't equate it in your mind to an IRA or a 401k that's just acting as a wrap around your investments and allowing you to defer taxation on it, then structure your note to pay out the full principal over a 10-year period of time in chunks and have a tax minimization plan in place to create offsetting investments that are like oil and gas or other ones that would offset those taxes I'm having to pay. And now at the end of the 10 years, I've got all my money. It's no longer in a trust. And I didn't just defer the taxes, but I eliminated them. And then you're done with the trust structure.
It's a good deal.
It's a great deal.
Do you ever have any clients who just, let's say, will a 10-year note, and they just do taking out pretty equal amount of principal every single year with no additional tax strategies? But because there's still some benefit to that, because at least you wouldn't be, depending on the size of the transaction, maybe not hitting the top marginal tax brackets.
Yeah. I mean, I think that's just very similar to doing a IRA to Roth conversion and managing your tax brackets.
Yeah.
Right?
Yeah.
Nothing wrong with that. It's an improvement over the alternative.
But it could be better.
It could be better.
Yeah.
Right? And so, if all you did was use the trust to shelter or defer the taxes and then broke the total installment sale up, truly principal and interest over 10 years, most likely you're better off. I'd have to run the numbers, and it depends on the amount that you're doing.
Yeah, definitely depends on the amount, yeah.
But why not layer some additional tax strategy on top?
Yeah. So when creating trusts, like let's say someone's trying to sell a business and they work with a financial advisor, do they just go to their financial advisor to help set up the trust, or how do they do this, and where do they find a trustee that would be considered to be like not within their control?
Well, so this is where I would tell you this is a great opportunity to find out if you have the right team or not. Okay. So for me, I believe the financial advisor, and I'm biased because I am a financial advisor. I'm not an estate planning attorney. I'm not a CPA. But I'm pretty confident in my opinion here. Okay. But then again, there's what's the rule where the more ignorant you are, the more confident you are in your beliefs.
The whole idea of ignorance.
Yeah, there's a whole famous psychological rule where the more ignorant you are, the more confident you are.
Yeah.
Hopefully, this is not one of those situations. But just in my experience, right, because the financial advisor is the one managing the assets, understands your life's goals, understands your expenses, understands the annuities, the life insurance, the portfolio, all these things that go in together, I believe they're the one best situated to help advise you on whether or not this would be a proper structure for you or not.
Yeah.
That's just me.
Yeah.
Okay. And so if you're working with a financial advisor that has no resources here to be able to bring to the table and help you put this together, you're probably working with a pretty low budget financial advisor.
Yeah, I mean, because you'd want to work with someone who can do whatever it takes to minimize the tax impact. Because if you don't have one that is able to, so what are you doing?
No, I mean, for real, what are you doing?
Yeah.
Right?
Isn't
What
the
good
whole
is it
point-
doing me to make you money? I mean, any monkey can make you money in the market.
Yeah.
Because the market is going to do what the market does for the most part.
Goes up.
It goes up.
Yeah. Stocks go up.
Stocks go up. Temporarily they go down, but over time they go up.
Yeah.
All right. This isn't rocket science.
Yeah.
Okay. And so if your financial advisor isn't approaching things from a tax centric point of view, I don't really know what you're doing working with them anyways.
Yeah.
Okay. Especially as you acquire more and more assets. Right. And so your financial advisor should be able to should have a working relationship with attorneys and trustees who operate in this space. Right? Because it's definitely not your financial advisor that's going to structure the trust for you. And it's not your financial advisor who's going to act as a trustee. That's not even legal.
Yeah. Oh, definitely not.
Right? And so I would find a financial advisor who actually has these resources at their disposal and has done this before. I mean, I can't even begin to tell you how many years we've been doing this.
Yeah. So when you have a client who is selling something, we'll say a business, and a trust is a good option for them, what does that process look like to get that set up?
Oh, it's actually super quick and easy. Okay. So the very first thing we do is we provide that paragraph that needs to go into the LOI, right? To make sure that it's put into the LOI. Because, and just so you know, I've done this with businesses who are being financed through the SBA, and the SBA never has a problem with this. Now, the opposing attorneys, if caught off guard, always have a problem with it because a lot of them don't understand it, okay? And I've had to, and usually I've had to have a meeting with everybody and get them all onto the same page, right? But you provide that paragraph, that goes into the LOI. When it comes time to, and then once you have an LOI, we usually spin the trust up. That literally takes a couple weeks, tops, okay? We'll usually work with the trust. We'll have the trustee brought in at that point in time. The financial advisor, the trustee, and the client will create the terms of the note, okay, that's going to be done. We wait until close, and we do what's called a double close. It's not a very creative name.
Yeah, at least makes sense.
Yes. This is done all the time in real estate, and so title companies and real estate absolutely get it. It's a little, like I said, it's a little more difficult to help the attorneys on the buyer side understand what you're doing. But really all they have to do, and I'm going to get into some detail here, is make sure that the asset purchase agreement, all they're looking for is that the asset purchase agreement from the owner of the business to the trust and from the trust to their buyer is exactly the same. That's it.
That's it.
That's it. Okay? Because you need a clear line, a lineage, I don't know what the term would be, of assets and liabilities to connect everything, right? And so then you've created the trust. You wait till close because you would definitely not want for the deal to fall apart and for you to have sold your business to the trust. Now the trust is holding the business.
Yeah.
Maybe it takes you 6 months to a year for another deal to come onto the table.
Keeps appreciating.
The business value changes, and now there's gains from the sale of the trust to the buyer. So you wait till the very same day, very same minute. The asset is sold to the trust sells the asset immediately to the buyer. Money goes to the trust. And what's beautiful about this is guess where all your commissions and fees and attorney's costs and everything come from? They all come out of the trust. Once the money hits the trust distributes your brokerage commissions, your attorney's fees, the fee that the advisor charged you to coordinate it all and set it up. It all comes out of the trust.
So there really is no out-of-pocket expense in that.
No,
in that year that.
No, we rarely charge anything to a client ahead of time to set everything up. Everything comes after close and paid out by the trust.
That helps with the cash flow quite a bit.
Big time.
Yeah.
Big time.
Wow. Nice.
So, and then you and your trustee and advisor sail off into the sunset and you collect that mailbox money.
Wow. Good deal.
Yeah. Yeah, it's pretty phenomenal.
So kind of getting closer to wrapping things up, do you think there's any pretty common misconceptions about setting up trusts for this purpose?
Oh, absolutely. The number one question I get is everybody thinks that when they do this, they've given the trustee the ability to steal their money and run off with it.
Yeah.
And it's fair enough. Right?
Yeah, I mean,
like, I don't want to.
It's the biggest sale of your life.
It's the biggest sale of your life.
It's your baby, all that money.
You've never heard of this kind of transaction before. You've never heard of this structure before. Your advisors have never heard of it. Okay. They're who I call your team of no. There is absolutely no incentive on their part to say yes. None. And there's only liability for them because they don't understand it. They know nothing about it. They've never done it before. They don't get it. Right. And so when you go to them, you're like, hey, what about this? Somebody told me about this. Are they the one getting to keep 30% of their life earnings? Are they the one getting 30% more income? Nope, nope, and nope. All right. So there is absolutely no incentive on their part. In fact, the incentive is for them to tell you no.
Yeah, because once that's in the trust, I assume they're not managing those assets anymore, so they're not making money on it, correct?
Well, exactly. And so quite often, I'm brought business owners, and they have a financial advisor who's not capable of doing any of this.
Yeah.
And all that guy sees is that for 5 years, 10 years, 15 years, he's been dreaming of the day you sell that business.
Yeah.
Right?
Yeah.
'Cause he's getting 5 million, 10 million, whatever amount of millions. And it's going to be the largest transaction of his life.
Yeah. He gets all that money to manage.
And he's just seeing all that AUM fee coming in.
Yeah.
Right? And so quite often, the business owner is at this moment of significant change. Change is risk. Risk is fear. The people around you are unequipped to explain it, to manage it. They're losing because you're about to fire them all. Because even you're a CPA. Your CPA ain't doing the taxes on the tax return for the trust. Right? So it's like it's difficult for people to, in a time of significant change, be willing to do more change. Yeah. Right? Yeah. They're giving up something they control. They're giving up something they understand, their business. They understand the income flow from it. And now you're telling me that it's going to go into this thing, this trust. There's this trustee, and it's not my money anymore. And it's the trusts. And it's like all this fear comes into play, right? And so it's very, very important that you work with somebody that understands it, has done it a lot, can explain it all to you. there's, if you think about it, when you put your money into the 401k, are you giving the people who manage the 401k the ability to steal all your money?
No.
No. When you give your IRA to a financial advisor, can your financial advisor steal all the money out of your IRA?
No. Still yours.
Yeah. So these assets are still held by a custodian. The custodian is still producing reports, right? You can still have clarity as to how those investments are performing and where they're held at and what they're in, right? Just like you would your IRA or your 401k, right? So it's just funny to me that everybody always thinks they're giving somebody the ability to steal their assets.
Yeah.
You're not, any more than you are with any other kind of structure.
Yeah.
And then I always tell people, I promise you the amount of money that is going into your trust isn't enough that I could steal it and run off to Venezuela.
Yeah, you're going to need a lot more than that.
Yeah. I always tell my clients, when I get to where I'm managing like billions, worry about me trying to figure out how to steal all the money and run off with it. Okay? But you're a couple $1 million. Like, why would I run off and steal it when I could just embezzle my little AUM fee from you every month? Right? And the trustee's getting the same thing. He's getting to take a little bit of a trustee management fee off not just your trust, all the other ones he's managing. Yeah. Right? And all those assets are held at a custodian. There's all sorts of limitations and safety mechanisms that custodians employ, like Charles Schwab, Fidelity, or whoever. And so, there's no more risk in my mind as to what happens to your money held inside one of these trusts than there would be with your IRA, your Roth, your 401k, your brokerage account, or something like that. Now, if you have the assets inside, go to something that is an alternative investment, a real estate portfolio. Well, now you're increasing the level of risk with your money.
Yeah.
Okay. Now it's not your real estate portfolio is not being held by Charles Schwab. Charles Schwab is not producing the reports on it, right? So it just depends on how the underlying assets are structured.
Yeah, and that's up to you to choose. So you're taking on that risk in that case.
And usually for our clients who do that, they're the one, they're the one determining what real estate investment to make, right? So, yep.
So anything else, or feel like
no? Like everything, I think being open-minded, educating yourself, surrounding yourself with the right team that's capable of doing things, that has a track record. Understanding that, I tell people all the time, everybody wants something better, but not different. Well, how do you get better without it being different? Right? So weigh the risk, right? Find a financial advisor who's done it, who's capable of it, that's got the right team around. Recognize that as you level up, you should be leveling up your team around you. Loyalty is a wonderful attribute unless it's costing you.
Yeah.
We're not here. That was the crazy thing is we're not here to make ourselves money. Yeah, we got to make money, right? But you can't look at somebody as your friend. I like them. It's your money. And if they're not capable of doing the right thing with your money, I promise you that personal relationship should not matter.
Yeah, 100%. You got to do what's best for you.
Absolutely, 100%, all day, every day.
Amen.
And level your team up and make sure you're in the right hands. So,
amen.
All right?
Sounds pretty good.
I think that's what we got for this one. Yep. If you want more information about it, hit us up as always. Check us out at alphi.com. For now, this is Elliot.
Nathaniel.
Signing off.